Staying the course. How to avoid emotional investing mistakes. One of the hardest parts of investing isn't the math, it's the emotions. Markets go up, markets go down, and when money is involved, it's easy to let fear or greed take the wheel. But the truth is, emotional investing mistakes are one of the fastest ways to derail your long-term wealth-building journey. 1. The problem with emotional investing. Many beginners panic when the market dips. They sell at the bottom and miss the recovery. On the other hand, when a stock is booming, people rushing out of FOMO fear of missing out, often buying at the top. Both scenarios are driven by emotions, not strategy. Pushpin story example. In 2008, during the financial crisis, the stock market dropped by over 50%. A lot of investors panicked and sold everything. But those who stayed invested and didn't let fear control them, they saw their portfolios recover and grow massively over the next decade. 2. Common emotional traps to watch out for. Fear of loss, selling too quickly when prices drop. Greed, chasing hot stocks or trends without research. Overconfidence, thinking short-term wins mean you can't lose. Herd mentality, following the crowd instead of sticking to your plan. 3. Strategies to stay disciplined. White heavy checkmark have a plan. Define your investment goals and strategy before you even buy your first stock. White heavy checkmark stick to dollar cost averaging. Invest small amounts consistently, no matter what the market is doing. White heavy checkmark limit portfolio checking. Checking every day can lead to anxiety-driven decisions. White heavy checkmark set rules. For example, I will hold investments for at least 5 years, or I will not sell during downturns. White heavy checkmark educate yourself. The more you understand how markets work, the less scary volatility feels. For mindset shift, think long-term. The stock market has never failed long-term investors who stayed the course. Short-term volatility is the price you pay for long-term growth. Light bulb analogy. Investing is like planting a tree. You don't dig it up every week to check the roots. You water it, protect it, and let time do the work. 5. Key takeaway. Backhand index pointing right emotional investing is one of the biggest threats to your success. By creating a clear strategy and training yourself to manage fear and greed, you'll be better equipped to build real wealth over time. Clapperboard hook for video. Want to know the number one mistake that destroys beginner investors? It's not picking the wrong stock. It's letting emotions take control. In this video, I'll show you how to avoid emotional investing traps and stay the course toward wealth. Understanding risk tolerance. Finding your comfort zone in investing. Every investor is different. Some people can stomach big market swings, while others can't sleep if their portfolio drops even 5%. This difference comes down to risk tolerance. How much risk you're comfortable taking with your money. 1. What is risk tolerance? Risk tolerance is your ability, both financial and emotional, to handle potential losses in your investments. It's shaped by age. Younger investors usually have higher tolerance because they have more time to recover. Income and savings. A strong financial cushion equals higher tolerance. Experience. New investors might be more cautious until they learn how markets work. Personality. Some people are naturally risk takers, others are risk averse. 2. Types of risk tolerance. Conservative investor prefers safe assets like bonds, CDs, or dividend stocks. Moderate investor mixes safe and growth assets, balancing risk and return. Aggressive investor focuses heavily on growth stocks, startups, or crypto, willing to accept volatility. Pushpin example. A 25-year-old saving for retirement in 40 years might choose aggressive growth. A 60-year-old nearing retirement may go conservative to protect wealth. 3. How to find your risk tolerance. White heavy checkmark, ask yourself, how much money can I afford to lose without panicking? White heavy checkmark, use online risk tolerance quizzes from brokerages. White heavy checkmark, test with small amounts before committing large investments. 4. Why it matters. If you invest outside your risk tolerance, you'll panic sell during downturns. You might take on too little risk and miss growth. The stress will make investing unpleasant instead of rewarding. 5. Building a portfolio that matches you. Conservative 70% bonds, 20% stocks, 10% cash. Moderate, 60% stocks, 30% bonds, 10% cash. Aggressive, 80% stocks, 15% bonds, 5% cash. Percentages are just examples. Adjust based on your goals. Clapperboard hook for video. Are you an aggressive risk taker or a cautious wealth protector? In this video, we'll break down risk tolerance, why it matters, and how to find your perfect investing comfort zone. The psychology of money, mastering mindset for long-term wealth. When it comes to money, success isn't just about numbers. It's about behavior, habits, and mindset. Many people fail financially not because they don't earn enough, but because they don't manage what they earn wisely. 1. Why psychology matters more than math. Two people can earn the same salary, yet one builds wealth while the other lives paycheck to paycheck. The difference lies in habits. Saving, investing, resisting lifestyle inflation, and controlling emotions. 2. Common money mindset traps. Lifestyle creep. As income rises, expenses rise just as fast. Fear of investing. Holding cash instead of investing due to fear of loss. Impulse spending. Emotional buying instead of planned decisions. Keeping up with others. Spending just to match peers or social media trends. 3. Wealth building mindset shifts. Think long-term, not short-term. Focus on value, not just price. See money as a tool for freedom, not just consumption. Practice delayed gratification. Sacrifice today for more tomorrow. 4. The role of emotions in investing. Markets move with fear and greed. Fear leads to selling too early. Greed leads to buying risky assets without strategy. Smart investors stay calm, disciplined, and consistent, no matter what the market does. 5. Building better money habits. Automate savings and investments so they happen without thinking. Track spending to stay aware of where your money goes. Surround yourself with financially smart people. Educate yourself regularly. Knowledge reduces fear. Clapperboard hook for video. Did you know that building wealth is 80% behavior and only 20% knowledge? In this video, I'll show you how mastering your money mindset can change your financial future. Dividend investing. Creating cash flow from stocks. While some investors chase quick gains, many wealthy individuals build passive income streams through dividend investing. This strategy allows you to earn money not just from stock price growth, but also from regular payouts. 1. What are dividends? Dividends are profit shares that companies pay to shareholders, usually quarterly. Think of it as a thank you for owning their stock. 2. Why dividend investing works. Provides steady income, great for retirement or financial independence. Offers stability since dividend-paying companies are often large, profitable, and reliable. Can be reinvested, dividend reinvestment plans, or DRIPs to grow wealth faster. 3. How to choose dividend stocks. White heavy checkmark look for companies with a history of consistent dividend payments. White heavy checkmark check the dividend yield. Typically 2% to 6% is healthy. Too high may be risky. White heavy checkmark evaluate the payout ratio. How much profit is paid as dividends? Under 60% is usually sustainable. White heavy checkmark focus on dividend aristocrats. Companies that have increased dividends for 25 plus years. 4. Dividend growth versus high yield. Dividend growth stocks. Smaller yield now, but increased payouts every year, great long term. High yield stocks. Bigger payouts, but may carry more risk, good for short-term income. 5. Building a dividend portfolio. Diversify across sectors, tech, healthcare, utilities, etc. Reinvest dividends to compound faster. Hold long-term. The power comes from consistency and patience. Clapperboard hook for video. Imagine getting paid every 3 months, just for holding the right stocks. That's the power of dividend investing. Let's break down how you can build passive income step by step. Real estate investing. Building wealth with property. While stocks and bonds dominate the markets, real estate has long been a cornerstone of wealth building. From owning rental homes to investing in commercial properties, real estate offers stability, cash flow, and appreciation. 1. Why real estate? Tangible asset. Unlike stocks, you can see and touch it. Cash flow. Rental income can create steady monthly profits. Appreciation. Property values often rise over time. Leverage. You can use other people's money, bank loans, to acquire assets. Tax benefits. Mortgage interest, depreciation, and other write-offs can lower your taxable income. 2. Ways to invest in real estate. White heavy checkmark rental properties. Buy and rent out homes, apartments, or condos. White heavy checkmark fix and flip. Buy undervalued property, renovate, and resell for profit. White heavy checkmark commercial real estate. Offices, warehouses, and retail spaces higher returns, but more complex. White heavy checkmark REITs, real estate investment trusts. Invest in real estate without owning property directly. Perfect for beginners. White heavy checkmark vacation rentals, Airbnb, VRBO. Great for high traffic areas, but requires active management. 3. Steps to get started. Educate yourself. Learn about mortgages, local markets, and property management. Secure financing, banks, private lenders, or partnerships. Start small, maybe a single-family rental before scaling. Run the numbers, cash flow, expenses, and return on investment, ROI, matter most. Build a team, realtors, contractors, property managers, and accountants. 4. Risks of real estate. Vacancies can hurt cash flow, property damage, or unexpected repairs. Market downturns, values may drop. High upfront costs, down payment, closing fees. 5. Real-life example. Sarah bought a $200,000 rental home with 20% down. After mortgage and expenses, she nets $400 per month profit. That's nearly $5,000 per year in passive income, plus property appreciation over time. Clapperboard hook for video. What if your house could pay you instead of you paying for it? Real estate investing is one of the most powerful wealth-building tools. And today, I'll show you exactly how to start. Watch out for the next chapter.